Okay, I'll switch to my headset here. Can you hear me on the headset or no? Okay. Hello? Hello? Can you hear me on the headset?
Yes, I can. You're coming through loud and clear.
Okay, so I can just start now?
Yes, sir. Anytime you like.
Hi, good afternoon, everybody. This is Chuck Hughes. It's great to be here today. Today I want to talk about profiting in volatile markets. And just as a background, I have over 28 years of trading experience, and I experienced very good markets, trading markets in the 1980s, 1990s, and the 2003 through 2007 bull markets. I've been using trend following systems over that 28-year period, and everything was going great, and it was pretty easy to make money whether you're taking long or short positions, because the market tended to trend. And that all changed about 3 years ago, and the markets became very volatile, and they don't trend much, so it's much more difficult to make money today than it was during the 1980s or 1990s. So I do have strategies that perform well in these volatile, non-trending type markets, and I'm going to show you one of those strategies today. And what I'd like to show you first is an example of the way the markets have been trading over the last 3 years. So I'm going to show you snapshots of the price movement of the S&P 500 index. And what all these price snapshots have in common is you see a lot of price volatility, a lot of wide swings in price, but the index is virtually unchanged. And all these slides I'm going to show you here in a second have that same characteristic. So the challenge is, if you're a directional trader and you trade stocks or options, whether you take long or short positions, when you're in this kind of volatility, price volatility with no trend, it makes it very difficult. So I'm going to show you a spread strategy that you can use that has been doing well these last 3 years. As a matter of fact, this strategy has produced over $1.1 million in actual trading, and over the last 3 years during these very difficult markets. So I'll show you my brokerage statements on that to confirm that. So here's another snapshot of the S&P. Again, you see these wild price swings and virtually no change in the index. And this is the price movement of the S&P in 2011. We had 68 days in 2011 during which the S&P closed up or down more than 2% in one day. So that's a pretty volatile price move to have 68 of these types of days. That's almost 25%, 1/4 of all the trading days that year. So that's a lot of price volatility. So again, you can see this price volatility and virtually no change in the index. Here's a snapshot 2010. Again, you see the price volatility, virtually no change in the index. Here's 2011. Again, volatile price swings, no change in the index. Now this is really interesting. This is a price chart of the S&P for year 2011. So this was taken December 31st, 2010 through December 31st, 2011. And the S&P started the year at 1257, ended the year at 1257. So that's a great example of how you have this volatility, and there's virtually no change in the index over that 1 year period. So very challenging for directional traders, whether you take long or short positions, to make money in these kind of markets. So here's another snapshot. I took this in July of 2012, and over the previous 12 months, you see a lot of price volatility, no change in the index. So what we're going to look at today is one of the strategies that I use that's been performing well in this kind of market environment, and that's trading weekly covered calls. And if you're not familiar with covered calls, the way you initiate a covered call trade is you buy 100 shares of a stock or an ETF, and then you sell a weekly call option. And I trade these in my retirement accounts. Most brokerage houses allow covered calls in retirement accounts, and because it's a lower risk strategy, it's actually lower risk than if you just buy a stock. So there's a new twist to this covered call trading. In 2010, they started trading weekly options that have a 1 week life. So with these, that changed this whole strategy, because before that I was selling monthly covered calls, and you'd sell 12 monthly covered calls over the period of a year. Now with these weekly options, you get to sell 52 premiums per year, and that's dramatically increased the profitability of this strategy, as you'll see in a minute. So just some basics with selling option premium. When you sell option premium, cash is immediately credited to your brokerage account. And with these weekly calls, we get to sell this option premium every week. And for example, if you sell an option that has 4 points of premium, then $400 in cash is immediately credited to your brokerage account. And this cash credit reduces the cost basis of the stock and reduces the overall risk of the trade. So selling weekly options allows you to compound these returns very quickly, and I'll show you some examples of that. So selling this weekly option premium can lead to a 100% cash-on-cash return regardless of the price movement of the underlying stock. So for example, if you invest, let's say $4,000 in a weekly covered call trade, you could receive up to $4,000 in cash income over the course of a year. Now you get to keep that cash income no matter what happens to the underlying stock or ETF. So a lot can go bad with your trade, and you're still going to make money with this strategy. And what I do is, with these weekly covered calls, is if I buy a stock or an ETF, I just hold that stock or ETF in my account. And then every Friday when the weekly option is expiring, I close out that weekly option, and then I sell the next weekly option. So I just maintain the stock or ETF in my account, and then every Friday roll over to the next weekly call option. And that way I'm just trading the options every week rather than buying the stock and selling the stock, or buying a stock and having it called out. Now, of course, whenever you have a covered call, there always is a chance that it will be called out, which is fine. Then it gets called, and then you just buy the stock again and sell another weekly option on Friday. But generally, I'm able to close out my weekly option on Friday, the one that's expiring, and then sell another option. So this weekly covered call strategy has been profitable in every type of market condition, and it incurs less risk than owning stocks or ETFs, because you collect this weekly premium each week in the form of cash that's credited to your brokerage account. So with weekly options, if you're not familiar with weekly options, they start trading on Thursday, and then they expire the following Friday, and they have a life of 6 trading days. And again, there's 52 opportunities each year to sell option premium, and this allows you to roll over your profits and compound your returns. So if you invest $4,000 in a weekly covered call trade, and over the course of a year you collect $4,000 in cash premiums, that allows you to compound your results, because you can, as you're receiving that cash, you can buy more shares of the stock and increase the number of covered call trades you're doing. So it allows you to compound your returns pretty quick. So over the past 3 years, despite these very difficult market conditions, my covered call trades have generated over $1.1 million in actual profits. I'll show you those brokerage statements here in a minute. And again, this was during very volatile, non-trending type market conditions. And over the past 5 years, I've generated over $7 million in gross option premium income. So in other words, there was $7,485,000 in cash credited to my brokerage accounts, mostly which are retirement accounts, using this covered call strategy. And in my U.S. Money Strategies book, I listed my brokerage trade confirmations that show this $7.4 million received in cash over the past 5 years with these covered calls. And this averages out to more than $124,000 in cash income per month over that 5-year period. Again, these are actual results, not simulated. And I've been trading in the international trading competition every year, and in 2009 I won the competition trading covered calls. Started with a $100,000 account, had a $122,000 profit. So I had a 122% return, and this is using real money. And the results in this trading competition are audited before they're published on the sponsor's website. So these are actual audited trading results. So I'm not trying to brag, but I'm just trying to show you that this strategy is for real, and it has been doing well in these volatile markets. So that's why I'm showing you my real-time results, just to see that, just so you can see that this strategy actually has been working very well. And this year I made as much as $68,000 in profits over a 1-month period with these weekly covered calls. So I'll show you my brokerage statement showing this $68,000 in profits over that 1-month period. So let's just go over the basics of selling option premium and how it works. When you short an option, the time value portion of that option becomes profit at option expiration. Options consist of time value and intrinsic value. So if you add the time value to the intrinsic value, you come up with the premium for the option. And if you trade at the money or out of the money calls, they consist of time value only. So with this weekly covered call strategy, what I like to do is sell at the money calls each week. And those at the money calls consist of only time value. So when you're short a call option, the time value of that option becomes profit at expiration, regardless of the price movement of the underlying stock, because the time value of an option decays to 0 at option expiration. So that's the basis of this whole strategy. You're selling time premium, and the time premium goes to 0 at option expiration. So if you're short that call, and at option expiration it goes to 0, then that's profit for you at option expiration, regardless of which way the underlying stock or ETF moves. So let me just show you an example. This is a trade I have on this week, and this is for the leveraged small cap ETF, symbol TNA, and I own this ETF in my account. So every Friday, what I do is I close out the expiring option and then I sell a new option. And this just shows you my actual brokerage account order. And I use spread orders to roll over these expiring options and to sell the new option. And here's an example of an actual spread order I used. This was last Friday, November 23rd. I closed out the 52 strike call, and then I sold to open the November 30th weekly call, the 54.5 strike. So closing out the November 23rd, which is last Friday, selling to open the November 30th, which expires this Friday. So I'm rolling over my options each week, and this is just an example of an actual order I use. You can see the bid and the ask for this, the new option, the November 30th, that expires in 2 days. The bid ask was, the bid price was 140, and the ask price was 145. So let's take a look at my actual fill for this spread trade. Of course, I closed out the November 23rd options, and now I sold short the November 30th options at 142. So I got, by using the spread order, I was able to split the difference between the bid and the ask. So I sold 8 of the November 30th 54.5 calls at 142, or $142 per option. So this shows how much cash was credited to my brokerage account last Friday for this trade, and it's $1,125. That's after about a I think there's about a $10 or $11 commission in there. So that's after commissions. This cash was credited to my brokerage account. So with TNA trading at 54.27, you can see right here it was trading at 54.27. So if it's trading at 54.27 and I sold the 54.5 strike call, that's higher than where the ETF was trading. So that would be considered an at-the-money call, and this 142 was all time value. And again, that time value becomes profit at option expiration because it decays to 0. So no matter what happens to TNA, that time value portion of the option, in this case $142 per contract, I get to keep that no matter what. So let's look at the potential cash-on-cash return for this type of a trade. So let's say that you didn't own TNA and you were going to initiate this trade last Friday. TNA was trading at 54.27, so you'd pay 54.27 points to buy the stock minus the option premium of 142. So that reduces the cost of the stock to 52.85. So if you were to buy 100 shares, this would be a $5,285 investment. So let's assume you didn't own the TNA like I did, and you're going to initiate this last Friday. So to do one of these covered call trades, it would take $5,285. Now let's just assume that you were able to sell a similar option premium each week, $142 option premium, and again, this was the time value of this 54.5 strike because it was an at-the-money call option. So this $142 that I collected was time value, and again, that becomes profit. So let's just look at the various scenarios. with this $142 in time value. If TNA stock increases in price at option expiration, you still collect that $142 of time value profit because the time value decays to zero. Now, you would lose money on the option, but you would gain money on the increase in the price of TNA. But you would still, no matter what happens, you'd still collect this $142 of time value profit. So let's assume that TNA stock remains flat, you still collect the $142 in time value. And if TNA stock declines, you still get to keep that time value, but your time value profit could be offset by a loss in the stock, depending on how far the stock goes down. So this just shows you the three different types of scenarios. The stock either goes up at expiration, it remains flat, or it declines. And in each case, you're going to collect that $142 in time value, and it could be offset if the stock declines, depending on the amount of the decline. But I'm also going to show you during market corrections, if a stock declines in price, then you can buy back the short call. You can buy to close the short call and then sell another option premium and collect two premiums in 1 week. And I just did this today. I had another ETF that declined today, so I closed out the option that I sold last Friday, and I sold another option today that expires in 2 days. So I was actually able to sell two premiums this week. That was for the FAS, the financial ETF. That was down a little bit today, so I was able to close out my weekly option and sell another one. So let's look at this trade that I took last Friday, and you get to sell these weekly options 52 times a year. So let's just assume that you got a similar option premium each week. So if you take $142 times 52 weeks, I would collect $7,384 in cash, and that compares to our original investment of $52.85. So if I collect the $7,384 in cash versus the original investment of $52.85, that's 139% cash on cash return over the course of a year. So even if TNA declines 20% or even 40%, if you're collecting 139% cash on cash return, a lot can go wrong with this trade, and I'm still going to make money. So again, if you're collecting over 100% cash on cash return, the underlying stock or the ETF could decline substantially, and you would still profit. Even if you had bad timing on when you entered the trade, you could still profit. So by selling these weekly premiums, you eliminate a lot of the risk associated with trading, in that if you're wrong about the direction, you could still profit on the trade. And if you're wrong on the timing and you enter at a bad time, you can still profit on the trade. So this makes up for a lot of potential errors you could make on establishing this trade, and you would still come out way ahead. You could also have volatile price swings in the underlying stock or ETF, and you would still profit. So this gives this weekly covered call strategy a huge advantage over stock and option directional trades that require the stock or ETF to move in the right direction in order for you to profit. So whenever you take a directional trade, whether it's a stock or you buy a call option, that has to move in the right direction or you're going to lose money. But with these weekly covered calls, the stock could move against you, and you're still going to have a profit. So also, if you're a directional trader, a lot of times you'll get stopped out during these volatile price swings if you use a money management system that gets you out of losing trades before they develop into big losing trades. So this gives this covered call strategy big advantage over trying to make money from directional trades. And if I was able to collect that 7,384 in time value profit, that allows me over the course of the year to purchase additional shares of stock and invest in additional covered calls, so I can start compounding my returns with these weekly option premiums that I collect. So let's just look at a couple of weeks, sample of a couple of weeks, and the amount of premium I collected. This week, I collected $13,588 in cash from the sale of weekly time premiums, and this column right here lists the amount of cash that's credited to my account after commission. So this particular week I had $13,588 in cash that was credited to my account, and this week I had $16,000 cash credited to my account, and these brokerage confirmation statements right here show in green, they show the amount of cash that was credited to my account that week, and that was $16,000. Here's another example. This week I collected $28,454. So these are just examples of weekly covered calls, the amount of time premium that I collected, which in this column it lists the cash that was credited to your brokerage account. So these are just examples of different weeks that I took snapshots of, just to give you an example of how much you can collect with this strategy. So if you were able to collect $16,000 in cash each week with the strategy over the course of a year, that could add up to over $834,000, and that would allow you to start compounding your returns when you're collecting that much premium. And this strategy works good during market corrections, and you can adjust the trades, as I mentioned before, and close out. If the market moves against you, you simply close out that short trade, and then sell another premium. And I'll show you an example of that here. And this week I collected $16,053 in premium, and then what I did was the market was down that week. So what I did is I bought back some of these options that were trading at a very low price, and it cost me about $1,000 to buy back these short calls and close them out. But then I sold another premium for that week, and then I collected an additional $6,600. So I went from selling $16,000 to selling $22,000 in premium that week, because I closed out some of the short calls and then sold calls that expired in a couple days and received some additional premium. So I call this double dipping, because you collect two premiums in 1 week. So this allows you to profit during market corrections and increased volatility. So let's just talk about rolling over these options briefly. If you roll over the option using a spread order, it allows you to reduce the transaction costs. And here's an example. This is for Apple. I owned Apple stock. I was selling weekly covered calls against my stock, and in this example I put an order in. I owned the February 24th 505 weekly call, so I was short that, so I bought to close that with the spread order, and then I sold to open the following week, which was the March 2nd weekly call. So closed out the expiring option, sold the new one with this option spread order, and of course that allowed me to reduce my transaction costs, commission costs, and also I put it in midway between the bid and ask price, which in this case, in this trade, was the bid was 1140, the ask was 1165. So I put it in midway between the bid and ask price. I usually get filled, and that way I can reduce my transaction costs by using a option spread order. Here's another example. This is for the emerging markets ETF. I closed out the expiring calls and then sold to open the new calls using this option spread order. And again, I usually put it in midway between the bid and ask price, and I can usually get filled at that price. Now, the reason weekly options are so much more lucrative for traders who sell time premium is because you get a lot more premium over the same period of time compared to monthly options. So what I did is I took a snapshot. This is an option chain for Apple. It was trading at 585.57. So if you were to sell the weekly call option, which expired in 7 days, if you were to sell the weekly 585 strike call, you'd get, if you just sold it on the bid price, you'd get 1405. Now, by comparison, if you sold the monthly option, the monthly 585 strike call that expires in 36 days, you'd receive 2830. So you can collect 5 of these weekly calls over that same time period. This expires in 36 days. So you could collect 5 weekly options at 1405, which would give you 70 points of premium versus this 28 points of premium for the monthly option over the same time frame. So that's why these weekly covered calls are so lucrative, because you get a lot more premium over the same period of time. Here's another example. This is for MasterCard trading at 457. Here's the weekly call, the 460 call trading at 1190, and here's a monthly option that expired in 82 days. So you get to sell 12 of these weekly calls over the same period of time, but you're going to collect, with the weekly calls, you're going to collect 142 points of premium versus 2350 for the monthly premium over the same period of time. So that's why these selling this weekly option premium is so lucrative, because you collect a lot more premium compared to monthly options. So let me just run through these brokerage statements real quick, and this shows $68,099 in profits after commissions over a 1 month period. And I'm just showing you this just to show you what I did over a 1 month period. And these brokerage trade or brokerage profit loss statements here show the profit for each one of these trades, and that it totaled up for $68,000 for that particular month, and about 80% of my trades were profitable. So now let's look at the my brokerage statements over the past 3 years, showing $1,116,000 in actual profits. And of that $1,116,000, $915,000 of that, most of that, was from trading weekly covered calls. So if you go back 3 years, they didn't have weekly covered calls, so I was trading the monthly. So some of this profit was from trading monthly covered calls, but most of it was from the weeklies. So These real-time profits, they just demonstrate the ability of this covered call strategy to deliver good returns over the past 3 years despite the difficult market conditions. So let me just show you these brokerage statements real quick. And again, these add up to $1,116,000 in total profits from trading covered calls. So I'll just run through these quick. You can see for yourself that these are actual profits, and this strategy really has been doing well over the past 3 years. Okay, and this is a snapshot of my 2009 trading contest account, and as I mentioned, I traded monthly covered calls back then because they didn't have the weekly covered calls, but I was able to roll over my monthly covered calls and compound my returns. So that year I had a 122% return from trading these covered calls, and that worked out to be about $122,000 profit. And again, these returns are audited, so there's no fudging these returns. And so I had 122% that year. And here's a snapshot from 2011. I had an average return in this portfolio 54%. And here's a snapshot from 2012, average return of 36.9%. So what I'm doing here is I'm setting you up for this next slide. And in this slide, what I want to do is take a look at the amount of investment capital required to generate $50,000 of yearly income using 1 year and 5 year CDs versus this weekly covered call strategy. So if you want to generate $50,000 of yearly income and you split your money evenly between 1 year and 5 year CDs, it would take $6,756,000 to generate a yearly income of $50,000. So not many people have $6.7 million they can invest to generate a yearly income of $50,000. Of course, with these CDs, you have no risk, but it takes an awful lot of investment to make this $50,000 in yearly income. So in contrast, if you saw where the covered calls produced 122% return in 2009, 54.8% in 2011, and 36.9% in 2012, and let's just assume that you're able to generate a 33.3% return, which is actually less than my actual returns over this 3-year period. It would only take $150,000 to generate that $50,000 a yearly income. And if you could get a 50% return, it would only require a $100,000 account. So that's a big difference, $100,000 versus $6.7 million. So I just wanted to give you an idea of the income potential from trading these weekly covered calls. So that concludes my presentation. I have an advisory service for weekly options, and we do have a covered call portfolio and a small account covered call portfolio, and these portfolios are doing real well. They've held up very well throughout the year despite the volatile market. So if you're interested in seeing the trading results, just log on to weeklyoptionalert.com, or you can call Brad toll free at this number, or just log on to the site, weeklyoptionalert.com, click trade results, and it will show you the current trade results. So I want to thank everybody for attending today, and I wish you the best in investing success. Have a great day, everybody.
All right, thank you very much for your time, Chuck. And that will conclude this presentation.